Today's earnings had energy manufacturers voluntarily eating a $40 million loss strictly to kill off their own custom contracts, and a food giant halted product development on its most famous soup, while a major ski operator proved its financial model is essentially immune to the weather. It is June 8th, 2026.
Right. It is a really revealing batch today. You have heavy engineering with FuelCell and Graham Corp on one side, and consumer reality with Campbell's and Vail Resorts on the other.
And the overall theme across all these reports is companies letting go of legacy models to match what the customer physically demands right now.
Look, let's start with FuelCell, because the tech demand for off-grid power is just breaking traditional manufacturing limits entirely.
It is. FuelCell literally wrote off a $42 million U.S. Navy submarine base project. They walked away.
Just took the impairment.
Yeah, strictly to shift that factory space into mass-producing, standardized off-the-shelf power blocks for AI data centers. Hyperscalers just cannot wait for custom engineering anymore.
Speed is the only currency there right now. But the underlying cash story was definitely less clean. While the stock spiked, FuelCell quietly hit the market to sell 15 million shares and hoard cash.
Which makes sense. You want the safety net, but you see that same kind of stark reality check over in the consumer aisle with Campbell's today.
That was a remarkably honest call. Management admitted that roughly 50% of their condensed soup volume is not eaten as soup. It is literally just a base for home cooking.
And rather than trying to, market their way out of that, they completely halted traditional soup research for those lines. They're re-engineering them physically purely as cooking sauces.
Well, margins are forcing that honesty. Campbell's functionally canceled all of their bakery trade promotions in Q3, just accepting lower sales volume to stop their gross profit from bleeding.
Right, sacrificing volume for margin, which brings us to Vail Resorts, because they had the exact opposite pricing dilemma.
The Vail numbers are incredible. The Rockies had the worst winter in 40 years. Industry ski visitation fell 24%.
Huge physical drop.
Massive. But Vail's total revenue only dropped 7%. The advanced season pass commitments basically nullified a natural disaster.
It is an amazing climate shield, but the inflation wall still caught them. They had to specifically slash pass prices for young adults because their price hikes accidentally froze an entire generation out of the sport.
And the weather hit did not actually disappear, it just got delayed. Early spring pass renewals are down 10%. That subscription fatigue is absolutely the biggest risk for them heading into next year.
That is definitely the metric to watch, along with FuelCell trying to convert their new 4-gigawatt data center pipeline from verbal proposals into actual cash contracts.
Right, without diluting shareholders again.
Exactly. The individual company episodes waiting in your feed have the complete call transcripts and breakdowns of exactly how these brands are managing these operational bottlenecks.